Well, hello everybody. This is Dave Burkus for an important insight from Burkonomics. Today's subject, warning, contractors must be truly independent. And we're going to talk about California's controversial AB5 law as well. Our challenge is getting more difficult. How many of us have hired independent contractors over the years, a bit worried over the gray area between employee and contractor as the IRS defines it, or separately the state of California and New York, and who knows how many more by the time you hear this. I've experienced the results of a wrong decision, and the IRS and state agencies are not forgiving in their pursuit of penalties and interest, and most damaging, assessing a company with those on both the employer and employee taxes when reclassifying the person as an employee. Yes, that's right. The company must pay the employee's portion of the tax and penalty on that, as well as paying those that would have been paid had the person been an employee in the first place. That's even more serious for today's gig workers. And California is the center of that today when being attacked by government, requiring them to be reclassed as employees. So there are 10 tests that the IRS uses. Actually, there are 20, but we'll talk about just the first 10. And here they come. You might write them down, or at least memorize them and be aware of them as you hear them. So here are those 10 tests. Number 1, an independent contractor must work under a written contract with the company defining the end result expected, the time to achieve it, a lump sum or unit cost, and the ownership of intellectual property that is created, and more. Number 2, direction. The contractor directs itself rather than being managed as an employee. And just as important, the contractor does not supervise any of the company's employees directly. Well, be careful of a contractor's CFO if not working for an agency, and many others who may be there to direct other employees but misclassified as a contractor. Number 3, integration. A contractor provides services which are not integral to the core business of the employer. This one's tricky for that CFO we just discussed, and there are others where you might find the employee critical to the core. Number 4, an individual on the job. A contractor may hire a substitute without the company's permission. Surprise? Although then the company should be able to terminate the contract if it is not an acceptable employee or acceptable contractor. Number 5, the term. A contractor is hired for a specific term and usually a specific project. An undefined period of time rules the favoring of that person as an employee. Number 6, reporting. Here's a surprise. The IRS wants the contractor not to require a submitted written report. What? Yet most of us would rather have that documentation along with an invoice to know what the contractor has done. Number 7, tools and materials. The contractor must supply his or her own tools. That's a bit tricky when the contractor sits at your desk and uses your phone all day, and that is one of those tests that you may fail without realizing it. Physical facility. The contractor must have his or her own home office, even if it's a little desk at the corner of the bedroom, so that that contractor can do business with other contractors or other businesses as well. Number 9, the contractor must work for more than one company. If a single person works only for a single company for a period of time, that person will probably be determined as an employee. A contractor must make services available to the general public. And finally, number 10 of these 10 tests, termination. A contractor works under a contract, which means the independent contractor cannot be fired as long as the results are satisfactory as the contract defines it. All right, let's turn to California's ABC test for gig employees. In California, there are still suits pending as of now as to whether the app-based gig employees, think DoorDash, Lyft, and Uber, and many more, are really employees. The state developed this ABC test, which has passed the state Supreme Court, even though there are still suits in the system that are challenging it, and it has swept up many people who are gig employees who really shouldn't have been part of the ABC test, such as independent musicians and artists and others who don't really keep track of their time necessarily as they work. So here are the tests. A. Companies must prove they don't control the work performed. Gig employers don't want to look like they control their contractors. As examples, Uber, which the company doesn't want to make look like it controls driver schedules. B, here's the killer. The contractor cannot work for the core concept of the business. Uber drivers state that they're doing just that, while the company claims it's just a platform connecting drivers to riders. And finally, C, the contractor must establish an independent business. That's hard for a Lyft driver that works only as a driver for that one company, or even if working for Uber as well. This is one of the challenges I think the courts will have to sort out, along with many of the other exemption requests and many of the other suits. Well, there are some ways for the companies to get around it. There are more tests, but these are the ones most often preferred by the IRS. States add a few of their own. California, now New York, and some others, beware. Pay contractors using the accounts payable system, not the payroll service. Pay only upon receipt of invoices, not with regularly targeted checks or transfers of uniform amounts without invoice to back them up. Well, there are some ways around this. Many small, early-stage company CEOs look for opportunities to cut cash drains, knowing that payroll is usually the greatest cash drain of all. The temptation to reduce that by 17% or more by classifying a gray area employee as a contractor is very high, and that includes self-payments to a founder. Founders working for a company are employees if they take regular payments, subscribe to company benefits, attend regular company meetings, and fail any of the 10 tests we've discussed. The temptation is just to draw cash and call it a loan, or to document a year's withdrawal with a 1099. That's great, but it's highly risky. There is nothing worse than a large tax bill or threats of a government agency seizing a cash account when a company cannot or does not respond with proper documentation and payment. And even a single year's worth of transgressions, when added into the single tax bill with penalties and interest, can appear daunting to small and young and sometimes very fragile young companies. Like payment of payroll tax and incremental impound each pay period, as opposed to waiting until the last minute and making manual tax payments, it is proper discipline for management to take the hit incrementally to protect the business from catastrophic failure to pay government agencies in any form of tax when it is due. Need we emphasize the personal liability of management and the board for taxes to any government agency? Well, good management takes discipline and enough knowledge to prevent these possibly crippling errors in judgment that stem from decisions made to avoid or put off tax payments when accrued or due. Pretty important, huh? This is Dave Burkus for more insights from Burkonomics. See you next time.